Oops.
Alrighty. All ready to roll? Let's go, Morgan. I'm excited.
Right on. Good evening, everyone. Thanks for joining us. We're going to introduce you guys to technical analysis, kind of what it is and how we use it to analyze a chart. So technical analysis is a method of analyzing financial markets by studying historical patterns. Volume data focuses on identifying patterns, trends, support and resistance levels to make accurate predictions about future price movement. The purpose is to provide insights into market behavior and help traders make informed decisions about buying and selling assets. It helps identify potential entry and exit points, determine risk levels, and improve overall trading strategies. It's important to note technical analysis is widely used by traders and investors in the Forex market because it provides useful information about market sentiment and trends. It helps traders anticipate market movements, manage risk, and increase the probability of a profitable trade. So what is the difference between fundamental analysis and technical analysis? Fundamental analysis involves evaluating the intrinsic value of an asset by analyzing economic, financial, and quantitative factors. So examples of that is your GDP, your CPI, unemployment rates, interest rates, whereas technical analysis is more focusing on the study of the price and volume data to predict future price movements. The main difference between fundamental and technical analysis is the approach used. While fundamental analysis looks at the underlying value of an asset, technical analysis focuses on historical price movement and patterns. So the pros and cons: fundamental analysis provides insights into the long-term value of an asset, but may not capture short-term price movements. On the other hand, technical analysis is more suited for short-term trading and provides specific entry and exit points. So the basic principles: price patterns are recurring formations on price charts that provide insights into potential future price movements. Examples include a head and shoulders, top, down, and bottom, and triangles. Trends refer to general direction in which prices are moving. They can be classified as an uptrend, downtrend, or sideways consolidation. Recognizing trends is critical in identifying potential trading opportunities. Support and resistance. Support levels are price levels at which buying interest is expected to be strong enough to prevent further price declines. Resistance levels, on the other hand, are price levels at which selling pressure is expected to be strong enough to prevent further price increase. So think of it as the floor and the ceiling of a house. You got to break through the ceiling to move price or break through the floor to move price. There are different types of charts. The most common is the candle, but there are also line charts and bar charts and candlestick charts. So technical indicators is moving averages. So simple moving average is a calculation that provides the average closing price of an asset over a specific period of time. It helps smooth out short-term price fluctuations and identify potential trends. An exponential moving average is a weight moving average that assists more weight to recent price action. It is more responsive to current price movements compared to SMA and is widely used by traders in identifying short-term trend changes. So the oscillators, there's your relative strength index. The relative strength index is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is used to identify overbought and oversold conditions in the market. Stochastic oscillator is a momentum indicator that compares the closing price of an asset to its price range over a specific period. It helps identify potential trend reversals and overbought, oversold conditions. So support and resistance, identifying levels. Support and resistance levels are identifying by analyzing price data and looking for areas where historically reversed or stalled. Traders can use various techniques such as trend lines or horizontal levels to pinpoint these areas. Importance in trading. Supports and resistance levels are critical for traders as they indicate potential entry and exit points for trades. Traders often observe how prices react at these levels to make trading decisions, such as placing a stop loss or taking profit. So supply and demand zones. Identification of a supply and demand zone. Supply and demand zones are areas of price on a price chart where the imbalance between buying and selling pressure creates opportunities for traders. Supply zones represent areas where there is a higher selling pressure, while demand zones represent areas where there is a higher buying pressure. Trading strategies. Traders can use supply and demand zones to identify potential entry and exit points. In a supply zone, traders may be looking for opportunities to sell or short a currency pair, expecting the price to decrease. In a demand zone, traders may look for an opportunity to buy or go long on a currency pair, expecting the price to increase. So the Fibonacci retracement. Fibonacci retracement is a technical analysis tool that uses horizontal lines to indicate potential support and resistance levels based on the good old Fibonacci ratios. These ratios are derived from the Fibonacci number sequence and are widely used by traders. The application. Traders use Fibonacci retracement levels to identify potential entry or exit points in a market. The level act as an area of interest where price reversals or trends continuations may occur. So this is thinking of your pullbacks and whatnot. The importance of Fibonacci retracement in technical analysis, as they can provide insights into significant price levels where traders can anticipate potential price movements. By combining Fibonacci retracement levels with other technical indicators, traders are more informed and can make more trading decisions. So chart patterns, reversal patterns, head and shoulders, double tops and bottoms, and the cup and handle. Head and shoulders. The head and shoulder pattern is a reversal chart pattern that signals the end of an uptrend or a downtrend. It consists of three peaks, with the middle peak, the head, higher than the other two, the shoulders. A double top or double bottom. The double top pattern is a reversal chart pattern that occurs when the price reaches a resistance level twice and fails to break it, signaling a potential trend reversal. The double bottom pattern is an opposite, occurring at the support levels. And then the cup and handle is a pattern on a bullish continuation pattern that resembles a cup with a handle. It indicates a temporary consolidation before price continues in its upward movement. So technical analysis strategies. There's breakout, trend following, and swing trades. Breakout strategy involves identifying key levels of support and resistance and entering a trade when the price breaks out of these levels. Traders aim to capture a significant move in the direction of breakout. Trend following. Trend following strategies involve identifying and following the direction of a prevailing trend. Traders aim to enter trades in a direction of the trend, expecting the trend to continue for a certain period. And then swing trades. Swing trade strategies involve capturing shorter-term fluctuations within an overall trend. Traders aim to enter trades at swing highs or swing lows, seeking to profit from the price reversals within that trend. So technical analysis is a method of predicting price movement in financial markets based on historical data and chart patterns. It helps traders to make informed decisions and identify potential trading opportunities. Technical analysis is not foolproof and should be used in conjunction with other forms of analysis. Constant learning and practice are essential for mastering technical analysis techniques. The importance of technical analysis: it helps traders identify trends and patterns, which can provide insights in future price movements. It can be used to determine entry and exit points for trades, manage risk, and set profit targets. Technical analysis is widely used by traders and investors to make informed decisions and improve their chances of success in the financial markets. Any questions on that? If not, we can hop on the charts here and so basically, like I was saying, price only moves in three ways. It goes uptrend, downtrend, or we can consolidate. That's the three movements of price. And usually the banks are in there playing with people's emotions, getting them involved in that consolidation. That's just basically them collecting liquidity, getting orders. So everyone has their opinions. So you have the sellers up here watching price come, and they say once it hits here, I'm going to sell. And then you also have the buyers down here saying every time it comes here, they're going to buy. And so the banks like this because they will create what we call an institutional candle. So they will force price right away, and then instantly they reverse it. So they'll come down here, sweep this liquidity, take out these guys. They'll come back up here, sweep this liquidity, take out those guys, mitigate their order, and drop price.
What do you mean when you say sweep liquidity, Morgan?
So everyone here with their trades, right? They usually put their stop loss behind previous structure. So this is all their stop loss. So that's the orders that they need in order to move price. Money is the fuel.
What does the stop loss mean there for people that don't know?
So usually it depends on the amount of pips. So when you enter a trade, this would be your entry, and then your stop loss is so you don't blow your account. When I trade, I only risk 1% of my account. So if price goes past this, I'm out of the trade in a loss.
Okay, so stop loss means you have while you purchase your shares, you've already put in a automated sell when it hits a certain price to the downside or to the upside for that matter.
Correct. So that's what we call liquidity sweep. They're taking the money. They're sweeping, they're taking the buyers' money and they're taking the sellers' money. Right? And while they're in this institutional candle, they've injected millions of dollars to move price. So now what normally happens is they're in drawdown the banks. So they would have bought here, then instantly moved price down. So they're in drawdown here, probably millions of dollars. And that's what we say by mitigating an order. They force price back up here, get out of that buy, and then they move the market the way they wanted to.
So when we look at charts on, let's say, Kitco.com, and you go to the technical chart, which most traders use, which is the candle chart, you have, okay, beautiful. You have them both in red and in green.
So this is the consolidation, right? And then you can see all these wicks. That's them clearing liquidity, right? They took out the sellers here. And now they've taken out the buyers, or the sellers and the buyers have taken out, and now they're in drawdown.
So what kind of duration are you looking at here on this chart?
This is the 4-hour. So they would have been in drawdown here. Right? Banks don't have set losses. But you'll see how they forced price right back. Got out of their order here. All right.
That's interesting. So how does the force happen?
So this is them. Well, everyone's buying and selling, right? Because banks need they can't just hit the buy button like you or I, right? Because they're injecting millions of dollars. So they're enticing
Right.
people to buy and sell. So once they get enough orders, they're going to move price and they have to get out of their order. So they force more. And once they close, their real sell happens. Look at that candle, right? They're taking,
Got it.
they need all that money to move price. And they do it again here, mitigate right
So
there.
so the pattern you see here is a very similar situation that plays out a lot of times.
Yeah, these are what we call the institutional candles, right? It's a buy candle or a sell candle before there's one here also, institutional candle. So they're selling to buy, right? Buy to sell. Because banks only do one of three things. They're sweeping liquidity or mitigating orders and filling imbalance. So imbalance is what you would see here.
Can you give a quick explanation of those three things?
Sure. So, so liquidity is all the set losses that people have in their orders. So whenever they do a liquidity sweep, they're basically just taking everybody's set loss. Say everyone set loss was here on this line. They just go into it, take that liquidity, use that money to move price up, get out of their orders. That's the mitigation, right? Because they're in drawdown here. They would have bought on this candle, buy to sell. Sorry.
Right. So even the banks are trading on very short term.
Yeah, they're usually on the daily and 4 hour, but everything in trading's fractal, right? So you can go right down to the 1 minute and see these exact same patterns.
Right.
It's all computer algorithms doing the trades. So they got to get out of this trade, right out of this buy. So that's why they're forcing price right out to there. And you kind of get out of that trade. Then the real sell happens because they took everyone's money and now they can re-inject and sell. And so they sell here.
That makes sense. And then the real market drops.
Exactly. Right. But now
So
there's this, I'll go replay mode. So the imbalance, so each candle has to have full candle coverage. That's the fair market value. So whenever there's an imbalance, they got to get price to balance out again. So we do have indicators that do show these order blocks. So you can see there's fair market value there, fair value gap, sorry. And then these order blocks. These. So this is when they buy to sell, they create these order blocks where they like to come back. And this is the supply zones that I talked about earlier. So that's a supply zone. And this is another one here.
So what can we take from the candle chart itself? Let's say we apply it to precious metals. We wake up in the morning, the market is open for, let's say, a few hours already around the world, 9:30 Eastern time. We have the New York markets open. Like what kind of patterns should we look for? And is it even possible to say, hey, I want to spend, let's say, $1,000 on silver today. I want to find out what could potentially be the best point in time today to buy. It might be 10 cents lower, 5 cents lower. or whatever that might be. How can we take any sort of data out of a 4-hour chart like this to make that decision?
So if you were to look at this, this would be your demand zone. And you got a fair value gap there. So we should anticipate price to move back into these areas. And that would tell you a good buying opportunity. Another option, we have the Fibonacci retracement. It's another tool we use. So this is discount premium, right? So this is your 50% equilibrium. So anything above here, you kind of want to sell, right? You don't want to be buying the tops, right? Because it's pretty good indication that price can reverse here. So this is what we call the golden ratio, this little box here. So if you have all these confluences that start adding up, so here would probably be a good buying opportunity too.
So an easy thing to do is, because what you often see when the market opens on the New York market, we either see a big sell-off happen in the morning or a big purchase, right? So usually the day starts with, or not all the time, but quite often with a fairly large candlestick, let's say.
Yeah.
Would it make sense to, at that point in time, take the 4-hour chart, break it up into a 50%, what did you call the red section again and the green section?
This is your supply and then your demand zones.
Okay. So you want to kind of break it up on the 4-hour chart in the supply and the demand zone, which would both cover about 50% of the full chart, let's say.
Yeah.
From lowest low to highest high.
Yeah, you go from your swing low to your swing high. And then you kind of find that's the Fibonacci ratio. That's always
Right.
in nature that you see. And that's how they measure pretty bang on with retracement also.
So you're saying that the yellow area that you have on your screen right now would be like, that makes sense that is a good buying opportunity.
Yeah, that's your 61.8 and your 5.5. So it's what's that saying is prices retraced 50% and then 61.8%. And then we have another one, the 71, which is another one that I like to trade off of. So
Makes sense.
quickly show you this one. Smart money. See how it lines up right in that demand zone. So we got institutional candle, fair value gap. So everything's lining up. So this is what we would call a decisional area. So you'd want to see a break of structure, break that structure, and then retest this area to buy up. Because what normally happens is price will play around and then just drop some more. So they always say structure is king in trading. So your market structure, that's a break of structure, BOS. Right? Break a structure, you're breaking out. And that's another way some people trade is they're breakout traders. They'll just watch this consolidation. As soon as it comes out, they're hitting that buy button. Or if it drops out of there, they're hitting the sell button. So ideally you'd want, if you're buying physical gold and silver, you'd want the chart to kind of speak to you, right? Trade what you see, not what you think. But ideally you'd want it to see it come down into this zone for a better buying opportunity and then head back up. That makes sense. But if you were to want to buy in this area, you'd want to see that break of structure first. That's another indication that price is going to reverse. Or you can get your head and shoulders patterns or whichever. Like that. So a lot with these equal, like if there was equal lows, there's a lot of buying and selling there. So people put buy limits there. And they come right in there, top there, set losses, and move price.
What does the blue indicate, Morgan?
This here,
Blue section. Yeah.
this is a demand zone. So this is where people are putting their buys.
Got it.
So
Okay.
you're basically
what is-
looking. So they're usually waiting for price to come back into this area. And right
Does
here you
it
got
make sense? Does it make sense to put orders in that range? Because if it would come down that far, there's also an possibility of a continuous drop, correct?
yeah. Because yeah, well, that's the difference between some traders, right? Because you can have a buy limit, or you can just wait for price to come into that area. As soon as you hit a buy or your buy limit, as soon as price comes into there, you're in the trade. But what a lot of traders will do is they'll wait for that break of structure, retest that area, and then get in the
That
trade.
Yes,
Right?
that
Break
makes
and
sense.
retest. Yeah.
So after a drop, correct me if I'm wrong, Morgan, if you have a whatever time frame, whatever timeline the chart might be for, you always want to wait for, let's say, moving 50% into the consolidation phase before you start to make a purchase or sell decision. Is that correct?
Right. Whenever you see a break of structure, you always want to expect a pullback. So what a lot of traders will do, they'll be buying, right? They get that FOMO and they just start fucking buying. Buy, buy, buy. They see that, they get excited. Then they just hit that buy button and then they get stopped out. So there's always that pullback. And that Fibonacci retracement, that's just the way we measure the pullback. And ideally you want it in that 7.1 to 7.8 range. And then you can see it comes in the golden ratio, takes off again. Goes back to this order block. Gets them out of that order. Right? They just basically break even or take a little bit of profit just to entice everyone in. And then the real move is right there, right? And then everyone's trying to sell. They see that big candle and they get excited. And then they're selling and then they get stopped out.
Makes sense.
Right? And then this
so
here,
are you placing your trades based off consolidation phases within the chart?
so normally like I'm looking for these kind of zones when I'm buying or selling. Like I would have a sell here, a sell limit. Basically just anticipating that, and then you can target previous structure. And then you'd be in that trade, right? So this could take days sometimes, depending on what time frame you're on. But ideally, like for a 4-hour, you'd want to drop down to a lower time frame and find a better entry, right? Because everything's a fractal. Like the same patterns are on every chart. Doesn't matter if you're on the 1 minute or the 1 day. They're doing the same patterns, right?
Patterns repeat all the time. Yeah.
Right? They're taking everyone's money. Up, down, And a lot of people they don't really know how to read trend, so they're getting stuck in that consolidation. So ideally, you want to see a break of structure, like it come out of that zone. And you can see here, we got different order blocks, right? They come up, move price, take everyone's money, move price some more, take everyone's money, move price some more. There's always a pullback after a break of structure. Right? And banks usually play off of the daily because they got all the time in the world and all the money. So there's your strong high on the daily. So the more closer you get to your strong highs, the more chances of a pullback. So ideally, if you were gonna sell this, you'd want it come up. Disrespected that zone, so they took all the sellers' stop losses there and then came back. So I would assume it's gonna keep going until we're in that next order block. Right, probably retrace. That's the zone. Then coming in here, take this liquidity. Right, and there's lots of fair value gaps here, so it could even retrace down to here to these areas. Because like I said, every candle needs to be fully covered.
What does that mean exactly?
So yeah, I'll just zoom in here a little better. So in every candle, either it's covered by the body or the wick of the previous candle and the one to it. So when it's not, they call that the fair value gap or imbalance. And that's like the huge difference between buyers and sellers. So there's a fair value gap here. So now we can anticipate the price will dip back into there because everything needs, the market needs to balance itself out, right? If you got 10 sellers in the market and only 6 buyers, you're only going to have 6 transactions. So they need to fill that gap and get price back to equilibrium and then continue on.
So that's very interesting because that means that if a candle always has to be filled, it will always come back down at some point soon or up if it's a sell to the bottom or the top of that candle.
Exactly.
That's great information.
Yeah, so back in like 2021, we were trading oil and it went down to like old 2008 candle on the daily. So like every time this stuff is going to have to be filled in. Same with here. So I do have an indicator here that does show. So you can see all those fair value gaps there. And there's an order block there, right? The institutional candle right there on the daily. Selling to buy. So they manipulated everyone to sell and then they bought, leaving all these fair value gaps. And then there's an order block down here in the 1820 range. Right? And those order blocks are just demand, supply and demand zone. So eventually price will get back to these areas. So that's kind of what we'd want to wait for if you're buying, but you can sell it if you're day trading it, right? So we buy and sell. But obviously if you're buying physical gold, you want to try to find better opportunities to buy. Medium discount here. right? So obviously you don't want to be buying in here because you're kind of still in the premium areas. Ideally, you'd want to get back down in here to buy. You have a nice little demand zone here. There. So even if, this is where your dollar cost average could come into play. You buy a little here, which keeps dropping, buy a little there, keeps dropping, buy a little there. And then you kind of equal out your gains and losses as she retraces back up. Kind of the same idea when you're buying and selling crypto.
So it's important to know that this both plays out on a 1 minute chart as well as a 1 month chart, basically.
Yeah, so
So-
everything's a fractal of the
Yes.
market. So the patterns can happen on any chart, any asset, right? But we trade with the bias that price is always being manipulated. And you can see here on the 1 minute. So you can see there wasn't a break of structure. It just kept going down and then it consolidates. So ideally, like if you want to start buying this up, you want to see price break previous structure. At least come up to this area. 15. Right, you'd want to at least come past here. And then start looking for buy opportunities here. Because without that break of structure, price will just keep going down. So it'll probably come down here, sweep that liquidity, maybe take that liquidity, fill that gap here. That's a nice big one. And then we use this little gamma box, kind of get a better entry. It's kind of the same as the Fibonacci. We'll just put a buy here. Of the previous structure. And I always usually go for a 3-to-1. So if you're risking $100, you're gonna make 300. This comes up, comes down. So you can see it's making lower lows and lower highs. So you'd want to see this structure at least be broken and then look for another opportunity to buy up. Because there'll be an institutional candle left here once they break the structure. If that makes sense. And yeah, it's the same thing with your silver too. Same ideas. I had a daily marked up here a long time ago. And it just always kind of comes back to the same areas. You can tell they're buying to sell here, came back down, got out of those orders, played around. But this liquidity, right, buyers, sellers, and then move price again. More consolidation. So they're just gathering orders, people's money, because the banks need our money to move price. You can't just, because in order to buy or sell, there needs to be a buyer or seller on the opposite end. That's how you get your equilibrium. Then you can see they bought, sold to buy. Creating another demand zone up here, or supply zone rather. And so they'll eventually make it back up to there. There's an order block here. Tiny, tiny little candle, but it's there. So another thing traders can use is an exponential moving average, which is the average of, depending on the candle. So if you go 50, that's the average of the last 50 candles. We also use 238, so Fibonacci number. So with that being said, this one would be the 50 on a higher time frame. And how we read this is if your price is below that EMA, you're in a downtrend. So normally we'll use that also as like a kind of a safety net for stop losses also. Because it would take a lot of money to break through that. And then when you're on top of it, you would be in a uptrend. Show you how the EMAs cross. So usually when these EMA crosses, so the 30 or 20 is the average of the last 20 candles. The 50 is the average of the last 50 candles. And this 238, I'll make it a different color, is the average of the last 238 candles. So whenever you see these EMAs cross, it signals like a trend change, right? The EMAs cross and we go on an uptrend. EMAs cross, we go on a downtrend. And then whenever it consolidates, they kind of rope. And then you kind of want to wait for it to open up, call that the alligator mouth. So the EMAs cross in here, starts another downtrend. And then your 238 kind of becomes your safety net. So if you were to trade just off the EMAs, you basically would find your order block. And then rather than targeting previous structure, you can just kind of target that and you get a tighter stop loss for a better risk to reward. The tighter this is, the more reward you get. And yeah, I think that's basically it. And then the RSI is another tool people use. So you got an equilibrium here. I'll just roll chart this. Whenever you're above this 70, you're kind of overbought. And then right away you can tell whenever they pop out, it's a good indication of a reversal. And same with when you're down here, you're oversold. And then people are going to start looking to buy again. So you just kind of stack these confluences up and you find yourself decent trades or opportunities to purchase.
Now, when there's a moment in time where it's oversold, is it a good place to buy at that point, or is there a chance of it continuing to drop? How does that work?
Oh yeah, it can always go further, right? Like 70s kind of
Yes.
you're good, and then 80s kind of really oversold. But normally, like you can tell, as soon as it kind of gets in that conditions, you're almost 90% oversold, overbought, sorry. So now people are going to start looking to sell when they do. And that creates a downtrend until you're down here below your 30. So when you're like below your 30 on an RSI, that's when you kind of want to start thinking maybe I can start buying because you now know that everyone's oversold.
Makes sense.
And then you just couple that with, price structure and market structure, sorry, and where your supply and demand zones are. Then you just kind of stack these confluences and you just make some more solid trade.
What platform do you use, Morgan?
This is TradingView that I use
Okay.
to mark
So
up.
you can mark it up however you want. You have tools available there.
Yeah, so there is a free version of it, but it's kind of limited to like the alerts and stuff because you can actually add an alert. So if you're saying, hey, you don't want to stare at this chart all day, you just say, give me an alert when price hits here. I got these little templates that I use. Right, crossing down. Let me know once per bar close. That means you want that candle to close below. There's a lot of times I'll just wick out. I'll come down and then wick and go back. So now I don't have to sit here and stare at the chart.
Right. So it's very useful there, guys. Like in the lives, let's say, we often round up our numbers when it comes to the amount of what we sell coins and bars for. If you go through all the websites, you'll see that it usually works in cents because everything is directly correlated to the silver price. So if you want to have a little bit more background, and I'm just sharing this to really take advantage of, let's say, price drops or prices going up when you're in a place where you want to sell. When we have a live, I usually round up the numbers. And of course, because it's aftermarket trading, there's always a little bit of margin being kept there. But if you go to any website, whether it's royalbull.ca or Silver Gold Bull or whatever website it might be, you see that the price updates itself every minute or every 2 minutes based off the live silver price or gold price. So by using a tool like this, and setting up certain notifications when prices hit a certain point where you want to buy can be very useful. And the reason I'm saying that is because while the markets are open, the margins on coins or on bars never change. So let's say Maples, we always buy at $4 over spot. We always sell them on singles for, let's say, $6 over spot or on volume of $5 over spot. So if you want to lock in silver purchases and you want to, for example, buy a dip and you anticipate a dip coming, but you don't want to look at the chart the whole day because you're working or whatever you might be doing, you can set up these alerts where you get notified. And that's a very easy way for you to start using this in a physical way. Get those notifications coming to you when price drops to a certain price point where you want to buy. And beforehand, you can already know the premium. So whether you ask me or any other dealer, you will also notice that they usually give you the price and premium over ounce, over spot. So let's say we can sell, or you can buy 10-ounce bars at $4 over spot. You ask any gold or silver dealer at the beginning of the week, it's like, hey, I want to buy silver at some point this week. What will my premium be on 10-ounce bars? What will my premium be on 1-ounce maples? Now, with premium, I mean the price difference between spot and the coin itself. So the prettier the coin, the higher the premium is. The bigger the bar, or the uglier the coin, the lower the premium is. With 100-ounce bars, of course, being the closest to spot, and 1-ounce rounds or half-ounce rounds being the highest above spot. So this can be very useful, and I actually have quite a bit of people do this. Not necessarily people in the group, because they wait for the lives to come up. That might not always be in your favor, guys. If you feel like the market might be dropping that week, ask what the premium over spot is on bars. Ask what the premium over spot is on coins. And then for yourself, set a price target where you can either check into the charts for every day, or you can set up these price notifications. And at that point, it's simply a message or a call, and you know exactly what you're going to be paying, even before you be picking up the phone or reaching out. That's how I kind of see looking at charts and taking charts into consideration can really benefit for especially buying dips when it comes to buying physical metals. I just wanted to add that to it.
Nice.
I believe there's a lot that we went over here. So guys, like, I believe this is recorded, right, Morgan?
Yeah, I got it. This recorded. You bet.
Yeah, we're gonna put this up in the group, and we're gonna add some additional resources to it, because there's also a lot of terms, Morgan, that you use today that a lot might not be familiar with yet. We can share those terms in the group so everyone kind of has an understanding of what is really being meant. And then I would recommend kind of re-watching, especially the last 20 minutes, where you really dug into the charts itself and in the tools of how to measure a future price.
So I did put together a free little like crash course here I can drop too. Basically market
Awesome.
introduction, basically how to set up your trading view, fundamentals, EMAs, TDI, divergence, point of control. Ooh, that's a good thing we can go with. Smart money.
Oh, this is awesome, Morgan. So you have a daily video.
Yeah.
How long is the crash course for?
Each video is about an hour long.
Okay. You got how many videos?
There's like 10.
Nice. So for the people that are really interested, that will be a great way to get fully up to speed on it. There's so much to cover. You can watch a video every day or one a week, and after 10 days or after 10 weeks, you'll have a really good insight into how this whole world works.
And then we have all these educators in the company I'm affiliated with, and they go live daily.
Nice.
So
there's a lot to it. Are there any questions off the bat, guys, of the last 20 minutes of looking at these charts, certain things that you want to know, or
so here would be a good example of like waiting to buy, because you're in this demand zone, but now you got these EMAs and they kind of act like a roadblock. So you'd want to break structure, break through these EMAs, and then retest whatever new demand zone is created. Right, so that's like an indicator of, because that's counter trend, right? Because we're below all the EMAs. So buying now would be considered a counter trend trade.
Right.
Most likely what's going to happen is it's going to blow through this area and go right down to that next demand, right? And that's why you always want that break of structure, because that's the first indication that price is going to change. You want to break previous.
So a hard piece of advice here is wait for consolidation of price, of stabilization, that short pattern, and then wait for either a breakthrough to the upside or to the downside, and then make your purchase based off of that.
Exactly. As soon as it blows through this area, there's no more liquidity, right? Until they get to the next order blow.
Right. So then you have to
That-
wait until the next consolidation phase before you make any new decisions.
Exactly. You just want to
So-
see, let price tell you what it wants to do.
So overall, when you're trading, Morgan, like how many and don't tell me if I asked too many questions, but how many trades would you make on an average day?
Well, maybe a few, because depends. Like I'll scalp on the 1 minute, and then sometimes I'll do longer trades on like the 1 hour.
Okay.
So, like say I'll do like I'll put in a bunch of orders Sunday, Monday night, and then they'll all activate throughout the week price as price
Mm.
comes to my entry, right? So you could say
So
say you set this up, the previous night. All right, you seen price this big bastard wick. So then you put in a sell limit, and sometimes they'll activate when you're sleeping or whenever. Because you're basically waiting for price to come back. There's your entry. That would have been a loss. So basically, that's what you're. So sometimes, I've had 5, 6 trades activate. Other times, you're just deleting them at the end of the week. Any ones that don't activate. But I try not to overtrade because you just end up giving money back to the market, right? The more you trade. And that's why your risk to reward is so important, right? Like the better your
yes,
risk to reward, the lower your win ratio needs to be.
that was my next question, because I feel very comfortable advising people to allocate, at least a small percentage of their overall investments into precious metals, and then I'm talking physical. And the reason why that is because, well, first of all, the second you buy physical, you're committed for a longer period of time, rather than buying any sort of digital position.
Right.
That's you. At least that's the common thing that we could say. When it comes to risk, we're all fairly comfortable investing or converting our dollars for physical metals. And we all kind of believe that over the long term, it's very difficult to go wrong. Now, what kind of risk is associated with this, the digital trading, let's say, on a day-to-day basis? So if you would look at, some people say, hey, don't they trade? There's a lot of risk associated with it. Does that mean there is innately a lot of risk to it, or is that simply a lack of technical understanding of charts or markets?
I would say it's not understanding risk management. So we only risk 1% per trade. So if you have $100 account, you're risking $1 to make $3. If you have $1,000 account, you're risking $10 to make 30. 10,000, 100 to make 300.
So
Right.
your trades are definitely leveraged.
Yes, they're leverage trades. You betcha. Then usually
Okay.
your broker will give you a 50 to 1, 200 to 1. And some of the unregulated ones will give you 500 to 1.
Wow. So what advice would you have on that front? You've been in it for 3 years, Morgan. Like, what if people are new to this and we say, hey, I want to set up an account for myself, put $100 into it to play with, to just learn. That's always my strategy in everything I've done personally. Even if I commit a small amount of money to it, with that financial commitment, for me, and I understand it's not for everyone, now comes a commitment of, hey, I better spend some time on this to learn it inside and out.
Yeah.
So if people say, hey, I'm interested to play with this world and I can afford to lose $100 and I'm interested in setting up an account, what kind of margins would you recommend of starting out with?
Well, you always want to start out in a demo account. So we call it paper trading. And you can have the exact same feel of trading, but you're you're not actually risking any money. So you can open a demo account with any broker and you're
Right.
just paper trading, right? And then you start growing that account as you would your normal account, and then go invest whatever you can, right? 500 bucks, 100 bucks, and you just follow the same rules, follow the same management.
So the 1% rule is big.
Yeah. So, and then I have this trade assistant. And this here will basically, so you choose your risk, 1% of my account. And this will actually figure it out for you, your risk and lot size. So you just basically click and drag the lines. And then this tells you your lot size, and that'd be you're risking $109 to make 445. You can see that. So there's your risk, and there's your reward. And then you can either hit buy or do a buy limit. Yeah. And so obviously you don't want to really be going for a 1-to-1 because then you basically have to always be winning your trades. But you just target previous structures. Well, that's kind of what that would look like on your MT4. You can see that 238 below.
Wrong screen, Morgan.
Oh. You see it now? The MT4 here?
Yes, perfect.
Yeah. So yeah, this would be the broker account. So I do all my analyzing on TradingView and then come and execute your trade here. And this takes all the work out of this trade assistant, takes all the work out of having to figure out your lot size. But yeah, free demo account is how you start learning.
What do you recommend for account?
Start with a demo. Like if normally what I would suggest if you open a demo account and you make it like the amount you think you'd be able to afford to invest. So if you can only invest $1,000, make it for 1,000. And then another thing too is there's what we call prop firms. And these guys will actually give you a funded account. You can do a free trial.
That's cool.
And so, yeah, they start at like $10,000 accounts up to 200 grand. So they'll give you $200,000 if you can prove that you can trade. So you're only allowed to lose like 5%, and then you get cut off. 5% drawdown or 10% the whole challenge. And then you get 80 to 90% of the profits. So say a $10,000 account, you made $1,000 in a week, that's 800 bucks in your pocket. So
Wow.
you're risking someone else's money and they're taking a cut for lending you the capital to trade.
Now
So
that just shows me there's way too much capital in the system right now.
$6.6 trillion a day.
Yeah.
So it's the biggest market. Like the global stock exchange total only combines like 40 billion a day exchange. So the foreign exchange market dwarfs the stock market.
How many trades do you do in precious metals, Morgan?
I mainly just trade gold.
Got it.
Um,
And that makes sense to me, right? Like stay You know what? When you start with one asset class and you do that for an extended period of time, you start to understand the trends very well. And I imagine the trends in each asset class are very different.
Yeah. So this is one of our educators, and he just does straight gold trades, and he'll give you trade ideas. And basically, like everything's $5. It's basically like the reason why we like trading gold so much is because it respects price so much.
What do you
Like,
mean when you say that?
like it'll hit these $5 zones, like 985. It hits these zones and tends to reverse every $5. Like all these levels, she taps into it.
Why is that? Do you know? Is
I'm
that
not
is
too
that
sure.
is that because it might just be one of the hardest assets you can hold or you can trade, basically?
Well, everything's like basically correlates with the DXY, the US dollar. So this DXY is dropping, usually your assets and indices are going up, right?
Rocco says there is basically respecting a certain daily price volatility range.
Yeah, like yeah, like volatility is usually for like trading the news and stuff, but we really we're just going from volume to volume. So another tool we use is this volume here. There. So this is like a volume controller. So this is showing us where the most buying and selling is happening. And this is the point of control, this red line. And that's where most of the buying and selling occurs in that time frame, in that range that we choose. I usually go swing high to swing low. So that's another indicator that you can target for take profits. This is a trade I called out to my team earlier today, and we're still waiting for it just to come up in here. So it's consolidating right now. We want it to come in here, and then it goes back down to these areas. And this video is all about that point of control and how to use that indicator.
So you only trade gold, Morgan?
I trade other currency pairs.
Okay.
Like US 30, I like to trade. The NASDAQ, and then various currency
Got it.
pairs, JPY, USD. Euro USDs has a lot of liquidity volume in it.
So I imagine that your account is USD based?
Yeah,
Yes, that makes sense.
you betcha. Trading dollars.
Yes. Well, it would add a whole other dimension to it when you have to take the Canadian FX into account, right?
Yeah. Yeah, like that's another thing about this these funded accounts, it's US dollars. So by the time you exchange it to Canadian money, it's basically 100% profit. If you're making $800 US.
Right. It turns into a few thousand Canadian.
Yeah, exactly.
Right. Very interesting.
Yeah, so you can see that it comes out of this zone. So if I anticipate it coming and be looking for more buys. And again, everything's fractal. But the banks are usually playing off of the weekly and daily. So whether you're scalping, depends on how you want to trade. I've been in and out of trades in five minutes making 3%. Or I've held trades for days and just moving my set loss into profit and just trailing it. That's another thing you can do when you're trading. Like if you're in a buy here, you could say you have a set loss. So ideally, you'd move it to break even, and then you can just keep trailing it into profit. So if it does reverse, then you're out in profit, right? So you don't always have to watch your trade reverse on you and lose. You can trail your stop loss in the profit. So if it comes back in here, you'd get 3% instead of where you targeted. That makes sense.
To me, it does, yeah. So well here, Morgan. I appreciate your time. Is there
You
any other
betcha.
questions, guys? Drop them in the chat for a minute, then we can answer them. And otherwise, we'll be posting some other resources in the group and might do it again sometime. Cool, guys. I'm gonna have to wrap up for myself. Maybe Morgan wants to kick around, but I'm almost at Tristan's place, believe it or not.
Thanks.
And we're gonna tune in here, and we might even be doing a live here for a minute and like 45 minutes. Who knows? So take
Cool.
care, guys. Thank you all for tuning in, and
Thanks, guys.
we'll talk soon. Take care.
I will throw the recording in the group. And if anyone else wants to learn more about the academy, reach out. We can have a conversation. But thanks everyone for showing up. It was fun. You bet, guys. Thank you.